Hello. Last lesson, we sketched the global market map, indexes and ETFs that let you reach beyond a single country. But once you hold names in New York, Frankfurt, Tokyo, and Sao Paulo at once, how do you compare them on one yardstick? How do you put Apple next to a European bank or a Japanese automaker and still speak the same language? Today's tool is the GICS 11 sector map, the shared industry vocabulary used from the S&P 500 and up to Europe, Japan, and emerging markets. Read sectors across borders, and you get an earlier feel for where each economy sits in the cycle, and why money can leave U.S. tech and pile into European financials or EM materials in the same Fed week. Let's get started. GICS stands for Global Industry Classification Standard, a world industry map. S&P 인도 세이해부 랑 이투 신수 1999. The S&P 500, Europe stocks 600, Japan's topics, and most emerging market indexes all follow this same framework. One label set, many tickers. Why one standard? So a tech name listed in New York and a tech name listed in Seoul or Tokyo can be compared with the same sector tag. It is the common language across countries and exchanges. Say information technology and Apple, Microsoft, and a semiconductor supplier overseas all sit in that same bucket, even when they trade on different venues and in different currencies. That shared map is the foundation international investors use when they allocate across borders instead of guessing by ticker folklore. The GICS 11 sectors really split into two teams, cyclicals and defensives, and that split travels well whether you're reading US, Europe, or Japan tape. The cyclical team, 6 sectors, surges when growth is hot and drops hard when it cools. Information technology, consumer discretionary, industrials, financials, energy, and materials. In a soft patch, IT can fall about 20% too, and financials about 15%. Illustrative ranges, not forecasts. The defensive team, 3 sectors, stays needed in every weather. Think a 50 grocery cart, a 20 prescription fill, and the power bill. Even when growth slows, households still buy food, medicine, electricity, and phone service. In that same soft patch, healthcare and consumer staples often hold closer to about -5%. Communication services and real estate sit somewhere in between, cycle-sensitive, but with some defensive DNA too. Why bother sorting them? So you can sketch which sleeves tend to lead at each stage of the cycle. Then ask the international question, which country's index is overweight that sleeve right now? Picture the economy as 4 seasons. In spring, early recovery, which stocks often led. Financials, early in a rebound. Rising rates can widen bank net interest margins. That can change with how fast rates move and what the Fed, or the ECB or Bank of Japan, does next. In summer, expansion, IT and industrials often take the baton. Companies invest again and demand for technology accelerates, from U.S. megacaps to global suppliers. In autumn, late cycle/peak, energy and materials tend to strengthen while inflation is still running hot. Oil at the pump and copper for factories both show up in that story. In winter, slowdown, money often rotates toward consumer staples and healthcare. Even in a recession, people still buy groceries and fill prescriptions, whether that car is priced in dollars, euros, or yen. That handoff is sector rotation, different sectors taking the lead as the cycle turns, and it is the bridge between a U.S.-only book and a true cross-border allocation. On this SPY Daily, line up the U.S. sector as beside it. Then remember the same GICS labels apply to international peers. The rotation jumps off the screen. Look at the March 2020 COVID shock. The financials at XLF fell first and deepest. Fear hit the banks early. It also recovered among the fastest. European and Japanese bank sleeves often echoed that path, with local FX on top. IT, XLK, avoided the worst of the U.S. drawdown and then ripped higher as investors priced in remote work. Global tech suppliers and ADRs moved with that narrative too. Trace the Fed's 2022 rate hike cycle on the same chart. Energy and financials showed relative strength. Gasoline got expensive at the pump, and banks earned more on loans. Energy-heavy EM indexes felt a different version of the same oil shock. IT was soft in that window. Higher rates discount future cash flows harder, so growth names and heavy global portfolios often get marked down first. That pattern, different sectors taking turns as conditions and Fed policy change, is sector rotation. The international twist is which country's index is overweight the winner.
더 S&P 500. Same GICS 11 레이벨즈 아일들이 디퍼런트 요이츠.
As of early 2026, U.S. information technology alone can be about 30% of the S&P 500. Many Europe and Japan indexes sit far lighter in pure IT. Europe's stock-style maps often lean more into financials and industrials. Japan's topics still carries a large autos and industrials footprint. Many emerging market indexes tilt toward materials, energy, and financials that dominate local GDP. So if you buy a global fund thinking you own a mini 500, you may actually own a bank and factory mix or a commodities mix under the same sector names. That is country sector concentration, not a bug. Practical read. If the S&P 500 is up 2% while U.S. IT alone is down 5%, other U.S. sectors carry the load. If EFA rises while U.S. XLK falls, leadership may have rotated abroad, not vanished. Watching only one headline index hides where the real action is. Read sector strength by country, and the true cross-border picture comes into focus. Bottom line, the GICS 11 sectors are a cycle compass you can use in every major market. Which sleeve is leading, and which country's index is overweight that sleeve, tells you roughly where capital wants to go. Practical tip. On TradingView, Park Financials, XLF, IT, XLK, Utilities, XLU, and Healthcare, XLV. On the daily, then add one international sleeve, such as EFA or a country. Those four U.S. sectors react sharply to the Fed cycle. The fifth chart shows whether the handoff is staying domestic or going abroad. Track relative strength across those panes, and you are less likely to miss a rotation that looks like U.S. soft/Europe or EM firm, rather than a single ticker mystery. Next lesson, FX, currency conversion, and hedging. The hidden variable that can cut an overseas sector win in half when you measure returns in dollars. International investing works top-down. See the whole sector map across borders first, then drill into countries and names. Today's 11 sectors are that bird's-eye view. This lesson is for education only, not investment advice. You own every trading decision. Think carefully, and great work today.